Warriors of price action and guardians of fundamentals. Welcome to Retail Recon. On today's episode, the objective is one of the core principles of risk management, position sizing. You will see what determines how much force I deploy on any given operation and the reasoning behind it. So gear up and let's go to work. Right from the start, hard code one fact into your system. If you're a seasoned operator, you already know this, and if you are new, it may surprise you. The hard truth is you are going to be wrong. A lot. In fact, if you could reliably hit even close to a 50% win rate with perfect consistency, you would probably be better off forecasting the future than trading. Trading is a game of possibilities and probabilities. Nobody can predict the future, so it is impossible to be right every time. You will take casualties. It's just the nature of the battlefield. If you're asking yourself, why trade at all if I'm going to lose so often, you are asking the right question. The difference is made on the occasions when you are right and on how you handle the times when you are wrong. You have probably heard the phrase, cut your loser short and let your winners run hundreds of times. Imagine trading like holding a defensive line. You are getting hammered constantly and taking small hits until one day an opportunity for a counterattack appears. Once the pocket is open, you press hard until you are deep in enemy territory. That is trading in a nutshell. Control losses so you can stay in the fight and exploit every opportunity the market gives you to advance. From my perspective, controlling losses, risk management, is more important than squeezing every last percent of the upside. Mistakes in risk are much more costly than leaving a bit of profit on the table. Small difference between doing everything perfectly and doing everything safely does not outweigh the increase in risk. After all, as traders, we don't expect to double our gains in 2 weeks anyway. If your goal is to double your investment over a long period of time, you may want to spend more time reading accounting statements than staring at charts. There are two basic risk management tactics in my protocol. The first rule is simple and non-negotiable. Always use stop orders. No exceptions. Everyone is different, but for me placing actual stops works far better than using mental stops. The set it and forget it approach frees mental capacity and keeps emotions out of the immediate decisions. Like most of you, I learned the lesson the hard way. Same old story. Stock gaps down and instead of closing the position, I kept it in a foolish hope it would recover. The ironic part is the trade was still profitable when it gapped and exiting would have meant only a minimal loss. That experience was enough to make always use stops, standard protocol, and just to have a constant reminder of that rule, I still keep the position open. In case you're wondering, the stock in question was Novo Nordisk. It is good to acknowledge that sometimes a hard stop will take you out of a position prematurely. The stock may recover and you might beat yourself over it. Don't. Just pay attention how often that situation occurs. If it starts to happen too frequently for your comfort, that is a signal that the stop orders need to be tweaked. Since a full episode will be dedicated to stop orders later, this will cover it for now. The second rule is all about position sizing, and I refer to it as use and lose or 210 rule. I'm not sure if anyone else coined this rule, and in case they did, they deserve the credit, of course. Back to the rule. You probably know that most accounts do not blow up because of the bad ideas. They blow up because of poor execution on the risk side. Remember, the goal is not to avoid losses, they will happen, but to make sure a single casualty never ends the campaign. The use and lose rule is all about position sizing. The use side. It determines how much capital you can deploy in any single position. For me, that is 10%. The lose side. How much of total capital can you afford to lose or risk on any single trade? For me, that is 2%. Hence, 210 rule. You can choose whether to calculate this on free cash only or on total capital including open positions. I use total capital because open positions still have value and can be turned into cash quickly if needed. Just keep in mind, that number is only valid at that moment in time. In volatile instruments it can change very fast. I always calculate both numbers before entering the trade. As this might be a little confusing, let's combine both rules and walk through a simple example. We will use Petrobras, ticker PBR, and assume an account value of $10,000. Under the 210 rule, or use and lose rule, maximal capital employed in this position is 10% of 10,000, which equals $1,000. That is our use side. Maximum risk on this single trade is 2% of 10,000, which equals to $200. That is our lose side. Next, we check the current price of Petrobras and its average historical price movement, also known as volatility. It is a deep hole to dive into, but we will keep it simple and use the average true range, ATR, as its metric. Suppose current stock of Petrobras is 12.28 and ATR is at 0.36. First, let's manage the downside to determine our loss level. Our ATR is 0.36. Quick side note, there are many ways to decide where to place a stop. You can use multiples of ATR, you can use support levels, moving averages, and so on. For this example, we will use conservative approach and assume 2 times ATR as our stop distance. Multiplying 0.36 by 2 gives us 0.72. That means each share carries $0.72 of risk between entry and stop. We will now use that number to determine the maximum amount of shares we can buy in order to max out the risk limit. As our maximum allowed risk or lose side is $200, 2% of 10,000, we will divide 200 with 0.72. Rounded up, that equals to 277 shares. Always round the numbers down. Next, let's check the capital side. Maximum capital allowed, or the U side, is $1,000, 10% of 10,000. In order to determine the number of shares, we will divide our maximum capital with the current share price. In our case, that is 1,000 divided by 12.28, which amounts to 81 shares. Because the capital rule is absolute, the position will be limited to 81 shares, even though the risk calculation would allow up to 277 shares. So we will submit a buy limit order for 81 shares at the price of $12.28 per share. After the order is executed, we will place the stop 2 times ATR below the fill price. If the fill was at 12.28, the stop goes at $11.56. Our end result, we have a position size of 81 shares. We have employed roughly $996 of our capital. Our dollar risk is our position of 81 shares multiplied by 0.72, which equals to roughly $58. As you have noticed, that is well below the $200 risk ceiling. If the target is a 2-to-1 reward to risk, the trade aims for about $116 of profit or $1.44 per share. From a 12.28 entry, that implies a target near $13.72, which is about an 11 to 12% move. For this example, that might be a bit overly optimistic, at least in the short term. This is just an example, not a recommendation to trade the sticker or use these exact numbers. If you want a deeper debrief of any piece of information discussed in this section, drop a comment below. Before wrapping up, here is a simple checklist to copy into your trading journal. Ask yourself these questions. What is my account value right now? What is my maximum percent risk per trade? What is my maximum capital employed per position? And where is my stop and what is the actual dollar risk on this mission? If you cannot answer these questions in under 30 seconds before deployment, you are not mission ready. This pair of rules has been employed for some time now and it works for me. Remember, as mentioned in previous episodes, do not blindly copy what others are doing, including this channel. Your situation, costs, and objectives can be very different. You now have the tools to build your own protocol. Test, adapt, and find what works for you. The best teacher will always be your own experience in the field. If you found value in this mission, lock in your support by liking, subscribing, and following our movement. Join the next episode where the tactics of position sizing and risk were pushed in real trade scenario. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.